It's not we do the reverse mortgage once all the portfolio money is down to zero. That's bad math. You do it in a coordination so that your $1 million still turns into $1.5 million if legacy gifting is part of your plan, or if you really want to have more distribution and not run out, you pull strategically from the line of credit so that your money lasts longer.
What is up, everybody? Welcome to another episode of the Financial Rebound podcast. I am so honored and grateful to have not only my close friend, my mentor, a big brother to me, but definitely a trailblazer in the mortgage industry and in the retirement income community, or retirement planning community, rather. I've got my good friend Rob Ziebart here. Rob, thanks so much for being on.
No problem, Mike. Thanks for having me.
Absolutely, man. So I know there's a plethora of topics that we can jump into. There's a few that, I say this all the time, and I don't brag about you because you're my friend. I brag about it because sometimes it just blows me away. I think you're one of the most dynamic professionals in our industry, and it goes, I talk about empathy a lot. I talk about really, you and I talk about always putting the client's needs before our own, doing the right thing. And I think you've done such a good job with that, with scaling Landmark Mortgage Planners to where it's at now, one of the top branches in the country here at American Financial Network. So I was honored to be able to join forces with you guys on that. Just life-changing for me. But I want to debunk some of the misconceptions out there about some of the things, get some of the strategies from you. And I know, if we talk about mortgage planning and its simplicity, it's about being there before, during, and well after the closing. And we hear that all the time. But what is mortgage planning to you?
Well, mortgage planning is everything for our business. It's really incorporating clients' long-term and short-term financial goals into the mortgage decision. So just sort of going with the flow or having the client tell us what they think they need isn't where we stop. We dive a lot deeper and try to figure out what their needs are, what their goals are. And oftentimes, unfortunately, find out people don't have any, or they're not very clear. So our recommendations in regards to how we structure a mortgage and acquisition of real estate really can change the long-term projections and the trajectory of their retirement years just by how we structure a deal today.
Love that. And that, and obviously if they go to our websites and things like that, the type of professionals we surround the client with, right? Whether it be financial advisors, life insurance specialists, the estate planning attorneys, clients get on the call with us a lot of times. We're going to give them their payment. We're going to give them their cash to close. We're going to give them all that information up front, at least an estimate. But I think, they don't anticipate, at least the feedback that I get is that, we're asking questions that they're not even thinking about, right? We're looking 40, 50, 60, 70. It doesn't matter. We're looking so far into the future. And you've really helped me dial that in. Now, this is to me, mortgage planning is just really how I think mortgages should be done, period. Right. But I understand that it took a lot of studying. It took a lot of Mike, read this book, Mike, come to this conference, you and I just talking for hours about, really about how you've helped create wealth for so many others. And it's heartwarming. With mortgage planning, and when it comes to the mortgage industry and buying homes or some of the methods people have been taught, where, and then this is something you talk about a lot, but where is the place that people lose the most money?
Well, I mean, if you're talking about wealth transfers, I'm assuming that's what you're talking about. So, there's 5 key areas that people are losing money unknowingly and unnecessarily in their current plan. And the number one is the mortgage. And so this is retirement planning, right? This is from a financial planner standpoint that we identify these 5 key areas. And the number one and the most misconceptions that are out there are, how do you most efficiently purchase real estate? Do you pay cash? Do you put the large down payment? Should you go with the 15 versus the 30? Should you pay the points? And really, it's a mathematical equation. And it's surprising to me how much bad information is out there and how many people get it wrong. And so it's been our sort of life goal, is to really set the table straight on that. Strategic equity, housing wealth. How do you really manage equity? We call it mortgages under management, and show people how to leverage, not only strategically, but responsibly, their housing wealth and their equity, so that they can improve their financial outcomes over time for the rest of the portfolio.
I love that. And speaking about strategic equity, it's something that, you've really helped me understand a lot better. And really the biggest winner of it is the client, which is amazing. But what are the top 4 ways you would say that people could leverage their equity effectively?
Well, I mean, it's depending. You don't want to put all your chips in that basket, I'll tell you that. So, I mean, everybody wants to pay off the house quicker, so they have a bunch of equity, but you get to retirement, you can't eat your house. And so what you've got to do is really be responsible in that. The misconceptions are, no matter what, a mortgage is debt and you have to pay it off. And really it becomes counterintuitive. But really, it's a Great Depression mindset that we inherited from our parents and our grandparents. And do you pay extra towards principal just as a matter of fact? Do you do that just because somebody told you to do it? Or do you not know where else to put the money so that it'll grow and compound over time and not be locked up inside the 4 walls of the home? And that's really where it is, strategic equity. So don't put all your money there. I'll tell you that. So 4, I don't even know what to tell you. I'm just saying, less money down, money off to the side. We call that equity repositioning, where we can take that money and instead of buying a house for $500,000 and putting down $300 and borrowing $200,000 because you don't want that high of a mortgage payment, does it make sense to maybe borrow the $300, have an additional $100,000 in your retirement plan so that it grows and compounds over a 20 or 30-year period? And what you find out is staggering how much more that snowball of money and that compounding will turn into over time for a small amount of a principal and interest payment.
I love that. And the opportunity cost calculator that you created is something that obviously is in the Housing Wealth Workshop, which obviously you created, and then I'm pushing here in Michigan. And I, every time I get to that part, I just, I see especially the real estate agents in the room, you can see the ones who really get it. They're, and I tell them, right, like you say, like, close with the cash offer, win the offer. We can come in, put delayed financing in place, but they are identifying these up front, getting it to me. We had one just, after the class last week. She calls me like 2 days later. She says, I'm going to show this client this house. It's $662,000 or something like that, some odd number. But they wanted to pay cash. And she still stopped them in their tracks. And that also, and not that, I told her to not proceed with cash or anything like that, but it was cool to see that she was willing to help them have a conversation about what would be best for them, rather than just get a paycheck. And, that was from a lot of the stuff that you taught me. And that opportunity cost calculator is a great visual of that. So now, one of the things that, again, when I say dynamic, and I think, you're probably too humble to say it, but I see when, there's so many misconceptions about reverse mortgages, and I see a lot of the financial advisors that really you end up educating on, and they get, their eyes are wide open to this stuff. But there's so many misconceptions about reverse mortgages. In a nutshell, I mean, and you can explain in as much detail as you want, but how do they really work, right? People think they what are the things we hear? You lose your house to the bank. All these misconceptions that are out there. But in all reality, it's probably one of the most powerful retirement planning tools. And can you elaborate a little bit on how and or why?
Well, it is. It's the most powerful financial planning tool that's out there. And I study financial planning and retirement income planning for a living. And I'll tell you, if people understood the dilemma and the risks that they're going to face in retirement and the sort of how it's not a doom and gloom approach, but it's just reality. Everybody's living longer. We haven't saved enough for retirement. We're going into retirement years highly indebted. And so we have to prepare for a long retirement. And it's not over at 65 years old. You got to prepare for another 30, 35 years beyond that. And the typical way in which people save for retirement is in qualified accounts, pre-tax, it's 401k, IRA. They stack their chips in such a way that it grows and they hope it grows and it comes down and it grows over time to the point where they retire and they start to take distributions out of the portfolio. And in that, you have to almost be a mathematician to do properly when you understand what sequence of returns risk and over withdrawal rate risk and volatility in the market, the things that can really gobble up a portfolio. As you're in distribution phase of retirement, taking money out, you really need another buffer asset to be able to draw from. We use a coordinated withdrawal strategy approach that says, hey, if the portfolio is down this year and your $1 million just came down to 900,000, so you lost 10%, do you take your $40,000 or $50,000 distribution from the portfolio that just took a 10% hit, or do you go to a different bucket of money to get that distribution from in an efficient manner? So we use reverse mortgage and specifically the growing line of credit for that. So there's so many ways that tool is used now from a strategic standpoint. It's no longer the tool of last resort and people doing it because they ran out of money. Really, what we're urging people to do, and what FINRA is, they're the ones that did the study recently. It's published in the Journal of Financial Planning, states that if you use this coordinated withdrawal strategy using a reverse mortgage growing line of credit, that you have an 8 times greater chance of cash flow survival in retirement, meaning 8 times less likelihood of ever running out of money, which is people's number one fear. They fear that more than death itself. So, and rightfully so. A lot of people are going to run out of money, and they need to have as many tools as possible to prevent that from happening. Reverse mortgage is clearly the best tool that's out there to help in that manner. It's not we do the reverse mortgage once all the portfolio money is down to zero. That's bad math. You do it in a coordination so that your $1 million still turns into $1.5 million if legacy gifting is part of your plan, or if you really want to have more distribution and not run out, you pull strategically from the line of credit so that your money lasts longer. And it's proven. It's a matter of math and science. It's not my opinion, thank God. I've done the research, but somebody else a lot smarter than myself has done the research, and it's documented.
I love that, and I love that you share that with me. Now, the coordinated withdrawal strategy was one of my favorite things that you showed me. You and I have had. I pulled you into a deal, and I still remember the client was crying at the closing table, and or after the closing rather, but tears of joy. And when I asked her, I said, why are you crying? She said, for the first time in my life, I know, well, one, she got her dream house, which I think you and I tried advising against because it was a little bit of a jump on but it was what she wanted. We were still able to solve her other challenges, which one of her challenges was when you had asked her, did your advisor talk to you about tax risk, longevity risk, any market risk, volatility, did she have long-term care in place? And she said no. So I was a little bit beside myself because that was one of the first ones that I saw. And what she said after the closing was, for the first time in my life, I know that I'm not going to run out of money in retirement, but more importantly, I know why I'm not going to run out of money in retirement. And that obviously, then I started crying too, and it was just such a heartfelt situation. But what would you tell financial advisors about this coordinated withdrawal strategy? Because I'm sure there's the 1,000 advisors or however many you're going to be speaking in front of in January, sharing this info that have been, really, really excited about it. But what would you tell them about this strategy? Because I think there's a lot of advisors that don't know that they probably have a way to save their clients' portfolio, and they're struggling right now because they don't know that there's a tool sitting there. What advice do you have for those financial advisors?
No, the advice is to get educated, and read the books. And, we've got great resources that outlines all of the math and sits with somebody like me or yourself that can go to the software and just plan it all out and show them how this growing line of credit will benefit. They don't think they need the money today, right? They're 65, they're healthy, everything's great. But what you've got to do is model that and say, okay, the house is worth 500,000. Line of credit is only going to establish 175, 200,000 today, but we don't need the 200,000 today. And we realize that. I understand you don't need it, but there will be a day that you're going to wish you had that money available. The good thing about the line of credit is it grows over time. So it's 200,000 today at 65, but at 85 years old, it's now $600,000. So the question becomes, is there any situation that you can imagine 20 years from now that not having access to this $600,000 of tax-free money would be better for you? And obviously the answer is no. So it's just really a matter of getting educated, understanding the math. And it's not too complicated. I think people complicate it because they're so used to thinking about mortgages as debt and this obligation that you have to pay for 30 years. But you don't even have to take the money, right? You just set it up and just have it as it's really a new savings account. Yeah, it's 175 or 200,000 today. It's growing at 7% and compounding tax-free interest on interest. Becomes a marvelous tool. So whether or not they're ever going to need a lump sum of 600,000, what you usually have is maybe a spouse passes away, we lose part of the income. Now we can very easily replace $40,000 or $50,000 a year, tax-free, not reportable as income, doesn't affect Social Security taxation. The line of credit can never be shut down, frozen, nor reduced, and it grows independent of the value of the home. So even if the home values are dropping in unique markets that we will face, that line of credit's continuing to grow in perpetuity. So, as for the advisor, it's really just getting educated. The amount of advisors I meet with on a weekly basis that have sold against reverse mortgages is staggering as well. It's really shocking to me that they have, reverse mortgages aren't for everybody. Okay, well, what does that mean? And they really don't know. They say these types of things, and it sounds great and it appeases certain audiences. But the reality is if you're going to call yourself fiduciary or holistic, you have to understand housing wealth. You have to understand this program specifically, because it's proven that the rest of the portfolio benefits when you use it. So you can't, again, in a holistic or a fiduciary role, tell somebody that, this isn't for everybody. That's not for you, if you don't clearly understand the math behind it. And what that means is you're willing to have somebody draw $1 million portfolio down to zero and then turn on a home equity conversion mortgage or reverse mortgage as a last resort, which FINRA does not like. That used to be their old approach prior to 2012. Now it's proven they want you to set it up the first thing in retirement. The earlier you set it up, the better. And that's just how it is. And so if you don't understand passionately the math behind that, then you have to spend the time to get educated. Come to people like us and we'll help you.
I love that. That's such a great answer. Now you hit on something important. You said, the reverse mortgage is no longer a tool where, people in the past thought or still believe that, it's for the person that just is in a strapped situation. I think what the statistics came out is that the number one utilizer of the reverse mortgage is the mass affluent. Can you elaborate on that and what that is?
Yeah, so it's no longer, again, the destitute or a last resort or somebody that's struggling. Certainly there's a great solution. It's a great solution for those folks as well. But the number one demographic over, I think, the last 6 or 7 years is the mass affluent. $75,000 a year or more in retirement income, $500,000 to $1.5 million in the portfolio, typically qualified money or some sort of a brokerage account, combination of the two, but you're holding on to a decent amount of money. You don't have a lot, but you don't have a little. You're right in that middle of the road, which is a lot of our customers, of course, in our country. And, so it's again, just something, people that are wealth minded do reverse mortgage. People that want to grow their wealth, they want to have more security. Maybe they can't afford the long-term care insurance. Most people don't have it, and they start thinking about it's too late. And even if they had planned, there is no long-term care policy that's better than the home equity conversion mortgage. So I study long-term care insurance for a living, as well as annuities and cash value life insurance, and I'm pretty well educated on all of it. But the reverse mortgage is the ace in the hole when you're looking at all of those needs.
And that reverse mortgage, the growing line of credit, I think a lot of times it gets confused with a home equity line of credit, but it's the opposite, right? It's compounding monthly at the same rate that the amortized portion of the mortgage is, where they can make a voluntary payment or not. But I think you're right. I think there's a lot of confusion, like how can this asset or how can this debt be an asset at the same time? Then it's compounding every single month. But obviously, when we sit with the advisors and show that illustration, or the client and show that illustration, to your point, I think it is not as complicated as some people want to make it. Now, so for the growing line of credit on the reverse mortgage, one of the things that, not that it has to be advertised, but the one of my favorite things on it is that growing line of credit is tax-free. Can you talk about why that's important?
Well, it's very important. We need tax-free, right? I mean, we got a tax bomb in our country in so many areas. And so to be able to have some sort of a savings vehicle that grows tax-free and compounds tax-free and is accessible tax-free, very, very important. So really, it really is an arbitrage tool, right? Like you mentioned, the line of credit and the loan balance grow at the same interest rate. So if you can visualize the loan balance being $100,000 and the line of credit being $100,000, a year later, the loan balance, your payoff, has grown to 107, and your line of credit's grown to 107. The magic really happens when you get your loan balance to be less than the line of credit, and then you have the arbitrage factor. We call it the smart way to own your home free and clear, where we pay the loan balance down to $1,000. Every voluntary payment that we make to get it there goes into the growing line of credit. So you end up with $1,000 balance on the home with a $500,000, $600,000, $700,000 line of credit. And so you can model so many different things, whether it's a big lump sum. Sometimes people want to use the money for investment, just liquidity. It's easy cash. It's available immediately. 48 to 72 hours upon request, you have the money in your account. You can take it $300,000, make an investment, make the returns on the investment, pay this back down, so that when you took the $300,000 from the line of credit, of course, it added $300,000 to the loan balance. Now you owe, instead of $1,000, you owe $301,000, and then whatever interest is growing in a 12-month period on that $300,000. Maybe it's $20,000 or whatnot for the year, but that allows you control of $300,000 without the mandatory payment. And like you said, the difference between the HELOC and the HECM is very simple. Take $300,000 off of a HELOC, you probably have a $2,000-$3,000 a month payment. Take your $300,000 off the HECM, there is no payment. It simply just adds interest to the loan balance.
I love that. Now, Rob, if somebody wants to reach you, we'll put all of your contact information on the screen for the videos. But what is the best way to reach you? I know you're on Facebook, you're on Instagram, you're on YouTube. But what's the best way for people to get a hold of you?
Well, my social media presence isn't quite that vast, but the best way to reach me is old school. My cell phone, 352-875-6907. Again, 352-875-6907. We leave the social media up to guys like you to stay in Hollywood, keep the lights on nice and bright. But as for me, just the cell phone, that's the best. And I'm always available. Evenings, weekends, we've run a big organization with a lot of moving parts, but If anybody knows me, they know that this thing's at my side at all times, and no matter what's going on, I'm pretty likely to answer the phone call. That's for sure. So if not, I'll be calling you back in a few minutes.
I can attest to that for sure. Well, Rob, thank you so much, brother. This is something that obviously we'll be doing regularly, because this is really our podcast that I know you got busy and with so many other amazing opportunities that you're bringing to the table. And, you know, you asked me to kind of take control of the podcast and push that. So, you know, you and I will be continually just jumping on here and doing a lot of the stuff that we talk about in these workshops, and giving maybe some real life scenarios of clients. I'm super excited to do that. And then
that's really, Mike, and I'll tell you, we have so many great success stories. We do need to bring them to the public so people can see how we're affecting lives for the better. And we take a very serious approach to that, where we look at it as a blessing and an honor to be able to serve people and to help them create a better path for their future. So I appreciate you putting the technology together for this interview and the ones to come, man. Great times ahead. 2025 is going to be amazing.
It is. There's so many people to serve. So, and speaking of 2025, me and you are 5 minutes late to our pipeline call, which has some people that we are serving in the end of the year and going into 2025. So I'm looking forward to the next one of these. And then obviously I will catch you here on our pipeline call.